When an investment bank like Goldman Sachs makes a big call, the market really pays attention. So today, we're going to deconstruct their latest report on VeriSilicon, a really key player in China's tech scene, to figure out exactly what's driving their super bullish forecast. So let's start right at the top with the headline from the report itself. This one sentence gives you the whole story in a nutshell. AI is the engine, the orders are just flooding in, and Goldman is telling its clients, hey, it's time to buy, with a way higher price target. Let's dig into what that actually means. So this is the number that's really making waves. Goldman Sachs has slapped a new 12-month price target for VeriSilicon at 193 renminbi. And look, this isn't just some small tweak. This is a major, major statement. And just to put that number into perspective for you, they've jacked it up all the way from 128. A jump that big tells you there's been a fundamental shift in how they see the company's future. It signals this huge boost in confidence, and it's all being driven by some powerful new data. So what's behind all this optimism all of a sudden? Well, it turns out VeriSilicon is sitting in this perfect spot, right at the crossroads of two of the biggest trends in tech today. First, you've got the global explosion in generative AI, which is creating this insane demand for specialized chips. And at the exact same time, you've got China's massive strategic push to build its own semiconductor industry from the ground up. VeriSilicon is right in that sweet spot. Okay, so at the very heart of this entire story is this specific piece of tech called an ASIC. It stands for Application-Specific Integrated Circuit. Now, the easiest way to think about it is like this. If a normal computer chip is a Swiss Army knife, it can do a bunch of things pretty well. An ASIC is like a surgeon's scalpel. It's custom built to do one single task with unbelievable speed and efficiency. And for AI, that efficiency is absolutely everything. And here's the hard evidence behind the hype. This chart shows we're not just talking about potential anymore. This is about real, signed and sealed business. This is VeriSilicon's order book taken right from the report, and you can just see that steep, powerful climb from late 2023 and heading right into 2025. And then, buried in the report, you find this absolutely staggering figure. The orders specifically for their AI ASIC design services, they shot up 700% year over year. That is not just growth. That is an explosion in demand. It's a massive confirmation that their tech is exactly what the market is desperate for right now. And all that incredible momentum led to this: a total order book hitting 3 billion renminbi. Now, if you're an analyst, this is gold. It gives you clear visibility into what revenue is going to look like down the road, and it gives you the confidence to forecast some really strong growth for years to come. So that massive order book directly translates into much higher profit expectations. And because of that, Goldman has gone ahead and revised its net income forecasts up, right across the board, especially for the later years. Look at 2029. They've raised their profit forecast by 15%. That tells you they're expecting not just more business, but a lot more profitable business. And that right there is such a key detail. This isn't just about selling more stuff. The report really emphasizes that these new AI projects are way more complex, they use more advanced tech, and frankly, they're just more profitable. So this shift in their business towards higher value work is what's expected to really drive up their margins, making every single dollar of revenue that much more valuable. So you might be wondering, okay, how do you actually get from some profit number in the distant future to today's very specific price target of RMB 93? Well, it's basically a three-step dance. First, the analysts forecast the company's earnings way out into the future, in this case, all the way to 2029. Second, they apply what's called a price-to-earnings, or PE, multiple. And finally, they take that future value and they discount it all the way back to today to get their final target. Now that number in the middle, that 41 times PE multiple, that is the crucial ingredient, right? So where does it come from? Well, it's not just pulled out of thin air. What analysts do is they look at a whole group of similar, fast-growing chip design companies, and they see what kind of multiple investors are willing to pay for their earnings. And based on VeriSilicon's expected growth, they decided that 41 times was the right benchmark to use. But of course, no investment thesis is ever a sure thing. The report is very clear about the risks here. The tech could end up developing slower than everyone hopes, the crazy race for top engineering talent could get even more expensive, or their customers could just pull back on spending if the economy gets shaky. These are the real hurdles they're going to have to clear. So this is where we're left. On the one hand, you have a company that seems perfectly positioned to ride this massive technological wave, and they've got the skyrocketing orders to prove it. But on the other hand, you have the very real risks that come with trying to execute in such a fiercely competitive industry. The optimistic case is crystal clear, but as always, the future is still unwritten.